Richard, let me be the first to ask a question which is going to be asked, no doubt, 5 million times in the next couple of days. Was last month, particularly for big tech, just a bear market rally or the sign of a real and longer-lasting turn upwards?
Well, Brian, we talked last week about getting away from this beats versus misses rhetoric and how simplistic that was. And so I think it's pretty clear to us that this was a classic bear market rally. If you look back at the dot-com boom, the bear market lasted about 860 days. In the global financial crisis, it lasted about 520 days, and we're about 200 days into this one. And I think what we saw last week with the decline in ad spend is that the professionals have voted. They've said, we're still going to keep orders going through the supply chain, maybe not so much for consumer products, but advertising where we can pare it back. We're going to reduce that. And this week, we're going to hear from the consumer discretionary exposed companies, whether it's Uber or PayPal or Alibaba reflecting Chinese consumer demand and others, eBay, that are going to reflect what's happening with the consumer, which may signal a bit of a different trend than the professionals because it tends to lag by a few quarters.
Yeah, and we had Sony overnight in Japan, by the way, come out and give pretty disappointing profit numbers and guidance as well. That's a consumer story because they were talking about weakness in gaming. You've also had companies like Google, Alphabet, talking about, it's top story on CNBC right now, Richard, increasing productivity, companies talking about slowing hiring. What are they saying in between their corporate speak lines?
So I think you have to look at some of these companies, especially, and again, Brian, we've talked about how well-managed big tech is relative to a lot of the smaller companies that don't have the adult supervision. They're founder-led companies. They might not have the same depth of resources. You know about the $300 billion of cash sitting on big tech balance sheets. And I think what those companies are telling you is they're happy to look through this cycle, this downturn, and prepare for the next one. I think you look at a company like Sony, it's trading at 1.4 times EV to sales. It's got a phenomenal spread of assets, and it's got that Japanese mentality that says we're happy to look on a 2 or to a 5-year plan. The same thing with Google, which is still going to spend $25 billion plus in CapEx this year and $25 billion plus in R&D. These companies are not pausing their businesses to hide under a rock for the next 18 months. They are pressing ahead, and I think you'll see a big difference in companies based on execution. I'll call out one other name where execution has been really disappointing, and that's Intel. And that's a name that we'd liked. We thought you'd have Pat Gelsinger in there to lead a turnaround, but the execution just hasn't been there yet. And I think that's going to really separate how the stocks perform. One other key point I'll mention, because you mentioned retail investors, realize that it takes professional investors several quarters to build positions in stocks. And what you're starting to see happen right now is people revaluing those assets that maybe they valued up to the moon when things looked great in November last year, and then they got too depressed about. But now we're starting to get a clearer view of which companies are going to make it through and we're still going to be talking about in the second half of 23 and in 2024.
But longer term, before we let you go, Richard, is there one name you just love for 10 years out? 10 years from now, not tomorrow, not 10 weeks, not 10 months, 10 years from now.
I mean, look, it's going to face some serious headwinds in the advertising business, but what company in the U.S. has a larger data center estate or a bigger asset pool in AI than Google? So, it's a company that's spending a huge amount of R&D. Today, it talks about pausing or slowing down hiring, but it's not pulling back from spend. You'll see a lot of other companies that don't have the 100 billion plus of net cash that it does to make it through this scenario. And I think one other one that everybody was so bearish on Apple heading into the quarter, we've kept it as a buy. I think that's, again, an incredibly well-managed company. It's absolutely exposed to slower consumer spend, but you realize that company still has a tremendous range of resources that it hasn't really monetized yet.